Welcome, friends. Today we are going to start with our new podcast, Smart Investing Strategies. My name is Prasad. I am a chartered accountant and a CPA, and I will be talking about investments, finance, some strategies, ways, and means to start your investments, so on and so forth. So, let us begin with today's topic, Introduction to Investing and Getting Started with the Basics. In this podcast, we will help you achieve your financial goals through sound investment practices. In this episode, we will discuss the basics of investing and provide an overview of the different investment options available. Whether you are just getting started or looking to improve your existing investment strategy, this episode is a great place to begin. Let us understand what is investing and why it is so important. So, investing is the process of allocating money with the expectation of generating a great return. We don't want our investments to be lying idle. We want them to grow. So, the process of investing is allocating money with the expectation of generating a return. By investing your money, you can potentially earn more than you would by leaving it in a savings account or other low yield investments. Investments or investing is an important part of building long term wealth and securing your financial future. When I talk to students, when I talk to students during our sessions on financial planning, one of the most important topics that I discuss with them is to start as early as possible. Yesterday was the right time to start investing, but it's never too late to start from today. The earlier you begin investing, the better your returns would be, and the process of averaging and compounding will do wonders or do magic to your principal amount. It will grow into a massive amount. So, investing is a process of allocating money with the expectation of generating a return, and that return can be a mammoth return if you start very early. There are several reasons why investing is important. First, it helps you grow your wealth over time. By investing your money in a diversified portfolio, underline the word diversified portfolio. Diversified portfolio of assets, you can potentially earn higher returns than you could by simply saving your money in a bank account. What do we mean by diversified portfolio? Don't put all your eggs in the same basket, else all will get spoiled. So put your money in different investment portfolios, be it stocks, be it real estate, be it gold, be it mutual funds, bonds, so that you are able to mitigate or minimize the risk associated with one particular portfolio by investing in other portfolios, thereby maximizing your returns or optimizing your returns and minimizing your risk. So, for a given level of risk, you are maximizing your returns by using a diversification of your portfolio. Second, investing can help you reach your financial goals. Whether you are saving for a down payment or for a house, or planning for a retirement, or maybe looking to build a college fund for your children, investing can help you reach these goals more quickly and efficiently. One of the most important aspects of investing is to identify what your needs are. You need to decide what your goals are. If you are able to understand what those goals are, you will be able to do that allocation of money for those goals in different avenues of investment. So, the first step is identification of your requirements or your needs or your financial goals. The purpose why you want to save money, for the purpose for which you want to use money in the future. Thereby, you will be able to start saving, start putting in some money on a regular basis. Finally, investment can help you protect your wealth from inflation. Over time, the cost of living tends to rise. and that can erode the value of your savings. No wonder nobody recommends you to save money in your savings bank account, because the inflation is more than the rate of interest offered by banks. So keep only the minimum amount that is required for your day to day expenses, or your short term liquidity requirements in bank account. Everything else you should put in some investment vehicles, because the cost of living is rising rapidly. The inflation rate in several countries has gone berserk. So it is very important that you start saving early so that you take the benefits of lower prices. As time passes, the prices are going to go up every year. Of course, you need to choose your vehicles of investments wisely. Otherwise, if you put your money in a bad asset, then certainly your returns are also going to be bad. So choose your investments very wisely. By investing in assets that have historically outpaced inflation, such as stocks and real estate, you can help protect the purchasing power of your money over time. Very important. If you want to beat inflation, you have to put your money in some instruments which are historically and expected to give you better returns than the rate of inflation, right? Now let us talk about the different types of investment. Where would you invest your money in? Well, everybody knows what are the different avenues of investment, but let us relook at those avenues. There are different types of investments available, each with its own benefits and risk. Mind you, risk is the overarching factor that you should consider when you are putting your money in any financial instrument. Without considering risk, you are exposing yourself to enormous amount of risk. So it is always important to look at what are the risks that are associated with a particular type of investment, and only then put your money considering those risks associated. Let us look at some of the most common types of investments: stocks, shares, as they are called, stocks, shares, one and the same thing. So, what does stock represent? It represents the ownership in a company. So, when you buy a share of a stock, you become a part owner of that company. But stocks can be very volatile in the short term. Historically, they have provided higher returns than other types of investments over long term. So, one of the most riskiest instruments in the market is stocks. However, the maximum returns that you will get are also from stocks. So, the philosophy that high risk, high returns, that is, you start investing in stocks, you are exposing yourself to high risk, but also expect higher benefits from those. Again, one more thing that is quite uh, mm, necessary to explain or to understand, when we say use this phrase high risk, high return, it is also important to look at the flip side of this phrase. High risk means high returns, but it also means high losses as well. So it is not only returns, it could be positive returns as well as negative returns. The more the risk, the more volatile your returns would be. So that is one of the important aspect. People tend to ignore the high risk, very low return, or losses that could even wipe out your principal. So investing in stock is that kind of investment where you have a high risk and you are also able to potentially get high returns. But again, with a caveat, if you invest wisely considering the risk associated with stocks, they have historically provided higher returns than most other investments. Bonds. Bonds are a type of debt security that are issued by governments, corporations, and other entities. When you buy a bond, you are essentially lending money to the issuer, who promises to pay you back with interest. Bonds are generally less volatile than stocks, but typically provide lower returns over long term. They are pretty risk free in a way, or there is very less or low risk associated with bonds, but the returns are also limited. They are generally issued by governments, corporations, or even entities, I mean companies as well, uh, maybe for infrastructure development, or for capex, or whatever reasons. So low risk, low returns or limited returns is how I would classify bonds as. The third investment is mutual funds, similar to stocks, but now mutual funds, you are able to diversify that investment in stocks. Mutual funds are type of investments that pool money from multiple investors and uses that money to invest in a diversified portfolio of stocks, bonds, and other assets. Mutual funds provide investors with a way to access a diversified portfolio of investments with relatively low fees and minimal efforts. For the millennials or many young people, I think when they don't have enough knowledge, or and they want to start investing their money in some investment vehicles, I recommend mutual funds as the starting point, because they don't have to think too much. The fund managers of the mutual funds are very capable people who invest the money wisely. Secondly, in mutual funds, all the money is not deployed in one particular stock or in one particular industry. They typically diversify that money into multiple asset classes. Could be gold, could be debts, could be equity, could be bonds, etc., so that the risk is diversified and the returns are optimized and the risk is minimized. So mutual funds is a great way to start with your investment journey. Real estate. Real estate includes investment in physical properties such as homes, apartments, commercial buildings, etc., or even land nowadays. Real estate can provide a steady stream of rental income and the potential for long term capital appreciation. But in real estate, the initial outgo of money or capital is massive. You can't start with a small amount, you have to start with a very big amount, either your own money or you have to borrow money from bankers to buy that real estate. So, again, the stream of income in the future periods would be significantly good, but the initial outflow would be very high. In last couple of years, although the return on real estate, barring except for a few places or few countries or few areas, the returns have been very stable and almost stagnated at a certain level, 8, 9, 10% or so. Again, it all depends on which area, what kind of real estate you are buying. But again, it's a pretty safe investment. Uh, has a potential of a wonderful long-term capital appreciation, but with a caveat, with one downside, that you have to put in a huge amount of money upfront. Alternative investments. Alternative investments include investments in assets that are not traditional stocks, bonds, or real estate, such as commodities, art, and cryptocurrencies. Alternative investments can provide diversification benefits, but tend to be more volatile and less liquid than traditional investments. Again, I mean, the fate of cryptocurrencies, etc., we have seen the volatility that has happened in several cryptocurrencies, moving almost 40, 50, 60, 70, or even 100% at times, plus minus. Many a times, many of the cryptocurrencies have given negative returns consistently for a very long period of time. Art, etc., are a wonderful way of investing. But again, the liquidity of art is pretty low. You can't just have artwork sold day in, day out. There is a huge amount of effort that is required to sell art. To establish the authenticity of art is another problem that many a times um, is a reason why people tend to move away from investing in art. So these are some of the instruments or vehicles of investment. If you want to start your investment journey, mutual funds would be the best. People who have the high risk appetite can go up with stocks. Um, but again, wise investing is what is necessary. If you have 100 rupees, start with only 10% of what you have and gradually start deploying your money. Have strict stop losses in your investments if you are a trader, And if you're a long term investor, make sure that you are investing in companies who have a solid management, who have given great returns, who have provided or given good dividends to shareholders, who are relatively debt free, who are profitable, so on and so forth. We will talk about all the stocks or all the parameters to evaluate those investments and which type of stocks you should invest into, etc., in the next episodes. How do we get started with investing? I know a friend of mine. I met him after a couple of years, and we were just talking, and we were just talking about the market in general and investing in certain stocks which were beaten down about 2 3 years ago. And he said, I have still not started investing. I mean, I just don't know how to start or where to start. And that is one of the reasons why many people actually are delaying their investing cycle or their wealth generation process. So getting started with investing can be intimidating, but it doesn't have to be, given that there are several ways in which you can start investing. In India, there are platforms. Every bank have a trading platform nowadays. Uh, Platforms like Zerodha, Upstock, etc. are great platforms to start with, where you can start investing money from right from 500 odd rupees, and slowly and gradually you can increase that amount. But let us start talk about how should one start investing. Okay, the first step is to set investment goals. So before you start investing, it is important to identify your investment goals. What are you trying to achieve with your investments? Are you saving for your maybe retirement, for a down payment of your house, children's education? So you need to set clear investment goals. It could be buying a car, buying a bike, or whatever. Your investment goals have to be very crystal clear. The time frame of those goals should be very crystal clear, so that you will be able to tailor your investment strategy to your specific needs, risk tolerance. So if you are looking for buying a house, maybe you should make sure you should start investing maybe early, because it needs a big upfront amount at the time of purchasing a house. So your EMIs or your investment should be such that if you have a goal of 5 years or 10 years, say 5 years, you need to start investing immediately, and maybe a reasonably big amount and a safer amount. So mutual fund would be a great way to start with that process, so on and so forth. So you need to decide your goals, you need to decide your time frame within which you want those amounts, evaluate what are the historical returns, evaluate what are the risks that are associated with those investment decisions. Secondly, you should create a diversified portfolio. One of the keys to successful investing is diversification. A diversified portfolio should include a mix of different asset classes such as stocks, bonds, and real estate, as well as investment with different levels of risk and return potential. So investing in maybe multiple industries, even if you're buying stocks, for example, don't put all your stocks in say maybe auto sector, or maybe in pharma sector, or maybe in banking sector. Diversified across all these sectors so that the cyclical movements do not affect your portfolio. So the auto sector may be booming in during the vacation time, or during the what do you call, maybe Diwali time, or the year end, etc. That is the time when auto sector goes very high. But that may not be the time for pharma industry. Pharma industry may pick up during the winter or maybe the rainy seasons, and sometimes that industry might be down, the other industry might be up. So the diversification helps you in mitigating the risk associated with the cyclical nature of businesses or industries. So this is just to help you reduce your overall risk in your portfolio, and the ultimate goal is to earn higher returns over a long term. The third point is to determine your risk tolerance, your ability or your appetite to accept a particular risk. Your risk tolerance is the amount of risk you are willing to take on your investments. It is important to understand your risk tolerance before you start investing so that you can choose investments that align with your comfort level. Generally, younger investors may be able to tolerate more risk than older investors who may be more focused on preserving their wealth. So, if you are maybe in mid 40s, 50s, your risk appetite should be lesser. You should not invest in high risk instruments. Whereas younger people in their 20s, early 20s, mid 20s or so, or maybe 30s, they have a higher risk appetite and they should start making their investments in stocks, etc. And they should be able to take higher risk and expect higher returns as well. So, but again, whichever way you are going to invest, make sure that you are preserving your wealth. You are not, your wealth or your principal should not get eroded at the end of the day. Consider working with a financial advisor. Most of the people, millennials or people who are not used to making investments, I think it is appropriate for them to consult a financial advisor. Most of the financial advisors, mind you, will provide you with good information, good knowledge, and good advice. If you're not sure where to start or feel overwhelmed with your investment options available, I think it is better to work with a financial advisor. A financial advisor can help you create an investment plan that aligns with your risk, with your goals, and your risk tolerance. I also provide you with ongoing support and guidance as you navigate the investing world. We are not right in front of the screen. We are not aware about various things that are happening in the industry, but a financial advisor surely is. He might be aware about by virtue of his position or by virtue of the industry in which he's working. He gets access to a lot of information. He can suggest you with the timing of those investments, when to exit, when to enter, when to accumulate. All of these aspects, a financial advisor would be the best person to provide you and help you achieve your financial goals. So, this is in a nutshell about the smart investing strategies. I greatly appreciate you guys listening to this episode. In our next episode, we will dive into the topic of maybe diversification, exploring the benefits of spreading your investments across different assets. Um, so this will continue with this journey about our the entire ecosystem of investment, the various tools and tricks that I can share with you. Maybe we'll also talk with some experts from the industry and get their insights also to help you in your investment goals. So that's it for now. Thank you for listening. And a humble request to subscribe to our podcast on all the major podcast platforms. So just hit the bell icon to make sure that you receive the new episodes as they are released. And for any additional resources and information, including show notes, guest bios, and links to helpful resources, please do visit our website at prasadkulkarni.com. Thank you very much.